Good morning, everyone. So, first of all, thank you to everyone who's joined us here in our Learning Saturday initiative. One of the reasons why we talk about the $1 million milestone is because we realize that for a lot of people, this is a very relevant benchmark to set in terms of growing your portfolio. Now, why is the dollar value that important? So, firstly, this is a moving goalpost in terms of you understanding where your global wealth is positioned. Second of all, I think for many of us, regardless of which stage in our lives we are in, the dollar still plays an influential role in sort of the amount of wealth that we have, right? How is this true? For example, if you have uh, children who you want to educate abroad, you are going to have dollar-based expenses at some point in the future. If, on the other hand, your children are already settled abroad, you're, say, in your 60s, at some point you may have to go and live with them where they are, and your spending power will also be linked to the dollar, right? You may like to travel when you're younger. So there are many reasons why having this as a benchmark in terms of setting your portfolio value. And even if you don't have any of these goals, right? When we look at a typical retirement corpus, even if you're entirely all your expenses are in India, it's a good number to start with. And this is broadly why we think the $1 million milestone makes sense for a lot of people. It fulfills many aspirations and it's a very practical benchmark for you to set in terms of how you're able to uh, translate the wealth that you have into a good lifestyle or a good in terms of fulfilling all of your aspirations. So when we talk about a $1 million milestone, normally what we think to the path of $1 million is we believe that you have to come from generational wealth, meaning unless you have a large amount to start with, you're not really going to be able to make it to that $1 million milestone. The second kind of expectation is that there will be a couple of lucky investments that pay off for the entire journey. The third thing is an assumption that unless we have a very high level of income, we are not going to be able to reach very large targets in terms of our portfolios. And lastly, similar to the idea of having one-off payouts, right? Or if you're having like a very good investment that goes, say, 5x or 10x for you, a multi-bagger, the idea is that maybe you got lucky in terms of working in a startup, or you have certain ESOPs or RSUs which have suddenly unlocked in value, and that's the only way for you to get to a larger milestone. But when we really think about it, I think the story or the journey to getting to $1 million, or how investors become dollar millionaires, is a little bit more nuanced. It's not just these four ingredients that can create that outcome. There are other things that play an important role. So, what are those other things? What we give less importance to, but actually sways the balance a lot more, is the fact that we need to have great financial habits, not just good habits, not just somebody who saves, but somebody who's saving, scaling, who shows a lot of investment discipline in the way that they have invested. They're not complacent at the wrong times in the market. They're not jittery when markets show them a different face. So it's about getting your habits right as well as your behavior right. And that can actually be a big game changer in terms of reaching these milestones faster, as well as not depending so much on the starting value of your portfolio to get there. Now, the fundamental truth is it doesn't matter if you're a high earner. What matters is if you're a high saver. Because if you have high income and high lifestyle expenses, and you have someone else who has a lower level of income, but they have a much tighter grip on their financial savings, they are going to be able to save more. And every contribution matters. The amount of time that you spend in the market matters, right? And that ultimately, when we look at the compounding equation, the thing that makes the biggest difference, right? So if you start tweaking the numbers and you start changing them one by one, you realize that what actually makes a material difference over time is the amount of time you allow the portfolio to compound. So the earlier you start, the longer you stay invested, These are the things that are going to influence your outcomes more than the amount that you start with, or how much you're earning. So let me illustrate this with a simple story, and you tell me at the end of this who you think would become a dollar millionaire faster, right? So let's say we meet two people, Anant and Bharat. Anant lives at homes with his parents, and he has no real financial responsibilities, right? His parents are financially independent. He doesn't have to pay for rent. He doesn't have to pay for a lot of things. Many expenses are taken care of. So pretty much every rupee that he earns is his to spend. And so he lives a very free lifestyle. He's able to go out with his friends often. He's able to spend on travel. He's able to do a lot of things and enjoy his money. Meanwhile, Bharat, on the other hand, is living away from home. So he has to manage a household, he has to pay rent. In fact, he even sends money home every month, right? And he realizes the only way for him to create wealth in this entire situation is that if he's very disciplined and controlled in terms of his budgeting and his expenses. So he runs a fairly tight budget. He makes sure that he saves every month, and every alternate month, whatever small amount is available, he is able to put that aside. This becomes the habits that both of them cultivate, right? So one person prioritizes having a good time, and one person prioritizes being disciplined with their savings habit. So when we think about Anand's situation, he's pretty much set for life because his parents are financially independent. He does not have to give them any money. He does not have to plan for their retirement. Whereas in Bharat's case, we've already established that every month he does need to send money back home. Anant also is no longer in the habit of tracking his expenses. There is no limit to how much he can spend. In fact, once he gets into the league of having a credit card, he is able to spend a lot more freely because he only has to pay the bill at the end of the month. This means he's able to indulge in more expenses, and this can include things like lavish holidays or luxury good purchases. These are things that Anand thinks is important in terms of creating a sense of financial well-being, right? Meanwhile, when we look at Bharat, like I mentioned, his system was to keep track of all of his expenses. He actually, once he gets a credit card, he realizes that there are a lot of benefits of having a card, right? Meaning there's a way to accumulate points, there's a way to extract benefits. You get a lot of services if you know exactly how to tap into each feature that is available in the card. And he continues to do this investment strategy where he is investing every month, and every alternate month he sees if he can put aside something more. So how did they manage their investments? For Anant, investing was just a hobby. It was something fun. It was something that was done with the money that was left over at the end of every month. It was not something that was planned or consciously designed, right? So his advice or his orientation to taking his investments seriously was to talk to people at that time, figure out what was trending, what people are buying. So he would chat with colleagues, he would have certain mentors, or he would go online and he would find the next best investment. And that is basically how Anant built his portfolio. Meanwhile, Bharat's plan was to set aside money from every single raise and bonus. So he continuously stepped up his investments, and he didn't stop investing regardless of how the market was. He just kept the faith that, okay, whatever happens, like this is money that I'm keeping for the next 15, 20 years, because that's how long it would take to build a 10 crore portfolio. So it doesn't really matter what's happening this year or next year in the markets, right? So now, keeping these two perspectives in mind, right? You do arrive at the question of who actually will get to $1 million faster. And I think it's fairly simple that unless, you start with a law, like if we look at somebody who starts with 1 crore, it would take about 20 years for that to compound to 10 crores, right? On its own. But somebody who is able to contribute regularly will be able to cut that timeline much shorter. So I think it brings us back to this thing of what is the way to win this race? Certain games depend on intensity and certain games depend on consistency. So when we all of us are familiar with the story of the hare and the tortoise, and we know that, in this case, we keep saying slow and steady wins the race. But I think the most important thing is not the slow part, it is the steady part, right? And when it comes to compounding, when it comes to unlocking larger amounts of wealth, steadiness and consistency are your best allies. Anybody who's able to do something consistently for a long period of time is going to come out stronger and higher than someone who's able to do it in short bursts across different periods of time. So, what you can sustain and what you can scale is the key to unlocking the maximum wealth that you can create in your lifetime. So now let's talk about where is it that things actually go wrong, right? If we are trying to create $1 million, what are the kind of roadblocks and obstacles that we tend to face in this journey? So I think the first thing, and I think most relevant to today's context, is the fact that market cycles are where we tend to go wrong. What do we mean by this? One, if we enter a cycle with a certain expectation, right? So if we look at how investors have looked at markets through 2024 to 2026 to date, like in the, say, the last 1.5, 2 years, the expectation was in 2024, the markets have been doing really well for the last 3 to 4 years. COVID was just a blip. Pretty much every down move in the market got bought. And no investor had really lost money in those 3 or 4 years. And there is a common thing saying that when you come into a certain investment, you give it 3 to 5 years, right? So with that kind of past success and track record, many investors felt that this is a great time to go all into equities. But when we look at how markets have reacted in the last 1.5, 2 years, specifically through 2026, you're seeing that market dips don't necessarily get bought. What is getting sold in the broader market, whether you're looking at FIIs or DIIs, is not necessarily what is getting bought, right? So there is a mismatch in terms of where there is risk and where there isn't risk. We're also entering a phase where growth has become a challenge. We can no longer take it for granted that India will continue to grow at, say, 7.5%, which is the narrative that was getting pushed around, say, in 2021 and 2022, where India was considered to be, the India story was kind of unlocking, and everyone was talking about how we have this demographic dividend, we have a long runway, and there is so much opportunity in this market. So what we need to understand is there will be a point where macros and everything are in favor for the investor. Then you experience a high level of return from markets. There will be a part of the cycle where macros are not so favorable. There is not that much uncertainty. And this is your sowing season, right? This is the ground where you have to plant your seeds, because when things start recovering, that is when you're going to reap the benefits. So if you're always going to start investing towards the end of the harvest season, you're only going to get a smaller harvest. You're not going to get that entire benefit that you could have got. So cycles are something where we tend to miss out. And we basically, the common culprit in terms of missing out on cycles is because we look at past performance, we look at confirming evidence, and markets don't really reward that. Markets actually reward somebody who's able to see through the uncertainty and expect a payoff in that context. So this is where understanding the cycle, understanding valuations can make a huge difference in terms of how quickly you're able to sort of create wealth and compound your money. The second, of course, which is linked to the market cycle, is the kind of choices that we make at any given point. So investor risk appetite actually changes across the cycle. And there's a simple way for us to sort of understand this, which is how much risk do you want to take at any given point in time? So if you were the kind of investor who in 2024, 2025 felt like you wanted to put more of your money in equity, towards the end of 2025, if you felt that it was a good time to participate in precious metals, because equities were not doing well, precious metals were doing so well, then it kind of gives you a sense of how your risk appetite has changed. right? So somebody who's saying that, oh, it doesn't matter, my horizon is 3 to 5 years, I don't mind investing in stocks today or equity mutual funds today. That is somebody whose risk appetite or willingness to accept risk is much higher. Whereas somebody who says that, what, like markets have not really done anything, I don't want to lose money, I want to at least maintain what I have, that person's risk appetite is much lower. And this shrinking and expanding of the risk appetite tends to go along with the cycle. When the cycle is not giving you returns, that's when risk appetite tends to contract and investors tend to want to stay out. And this is basically how we are tuned to behave. We need to kind of restructure our behavior and realize that when market risk, like when markets are not giving you a lot of rewards, that's when you can afford to take a little bit more risk, and you can afford to be a little bit more patient, and you can afford to invest not just time but also money in your sorry, not just money but also time in your portfolio, right? So when you expand your investment horizon, when you expand your risk appetite, when the market is not favorable, that's when your compounding return actually turns out to be a little bit higher. So our choices determine where we go. So it's of course, one way to look at it is, even if you make the wrong choice, time will kind of correct the portfolio. But the best thing to do is to be able to walk out of bad choices and restructure, right? Mostly because when we expect time to correct a portfolio, we get impatient at some point and we might exit at the worst point rather than an all right or a mediocre point to exit. The third thing that can be a big obstacle in your journey is complacency, which is sometimes when we see that we've made great returns, we tend to think that, okay, let's wait a little bit longer before we get out of this. There's no need to book profits right now. This investment is doing so well. Anyway, whatever happens, I'm not going to go into a net loss, right? What I lose is some portion of my returns. Or when we think that, we are presented an opportunity where there is uncertainty, sometimes we might wait for confirming evidence. So this act of waiting and watching, whether it's in terms of booking profits or participating in opportunities, actually holds investors back from achieving what they can. If you're a little too early, you just have to extend your horizon. If you're a little too late, you have to hope that things turn out in your favor, right? And that is a much more uncertain decision to actually be sitting. The next thing that we could look at is in terms of lifestyle creep. This is that as when you're starting this journey, so we run a program called Milestones to Wealth as well on the mutual fund side, where we take investors from where they are to their first crore in savings. Once you get to that 1 crore milestone, then we look at, say, $1 million milestone as the next thing for you to achieve. So you're going 10 times roughly in today's value from where you are. Now, there is something known as a wealth effect, which is when you start thinking you have more spending power, you tend to spend more, right? So you see a lot of lifestyle upgrades. And while this is important, I think the key thing is to strike the right balance. As you start earning more money, you should maintain or increase your savings ratio. Meaning, let's say you were earning from your first job, say 30,000 rupees every month. You were able to save about 5 to 10,000 rupees depending on how the month went, right? When you move to 1 lakh, if you're still going to keep your savings at 5,000 or 10,000 rupees, you're not really going to move the needle in terms of your wealth. And when that income again increases to say 3 lakhs, you've gone 10 times to your original thing. Of course, you will have to adjust for inflation and all of those things. But unless you move your savings from say 15 to 30% and you take it to 50% of your income, then you're still leading a pretty good life. You're still also saving a lot more, right? So lifestyle creep is when your entire income revision goes towards expenses or more than that, right? And this is something that I think all of us are tempted by, because suddenly when more things become available and affordable to us, we do want to indulge more. So this is something where I think it's a lot about being self-aware as well as knowing what you really enjoy. So If you really enjoy traveling, then of course a luxury holiday every year makes sense. But if that's not something that you want, but it's just something you want to show other people, then you need to rethink that expense as to why is it that you want to do it, right? So it takes some level of introspection to really overcome lifestyle creep. And at the same time, you want to also enjoy the fruits of your work in the present as well. So that's where striking that balance makes a lot of a difference. And lastly, it boils down. I think if we had to think about one word in this journey that can be a game changer, it is going to be discipline, right? So if we're not disciplined with our emotions, if we're not disciplined with our money, if we're not disciplined with our habits, you are going to slow yourself down on this journey. And cultivating that discipline really helps if you have someone else in this journey with you, because it's like going to the gym, right? If you're consistent, you get the outcomes that you want. Having a trainer or having a core group who show up every day motivates you to get more done in that same time that you're investing every day. It's pretty much the same thing with investing. So where are we today in terms of markets, investments, macros, habits, and expectations? So I think one thing to make very clear is that this is not an easy market to be an investor in. You are going to see ups and downs. You are entering into a phase where there's higher inflation, there is potentially lower growth. There's a lot of uncertainty because whatever we've seen since the Iran war, there is a lot of back and forth in terms of how outcomes are playing out. We're already at a point where oil prices are high. There's a lot of pressure on the rupee because of our import bills, because not only is oil more expensive, our energy demands have actually expanded. At the same time, we're not importing less gold than we were. All of this is putting pressure on the rupee. And of course, we're also in a phase where we've had heavy FII, FDI selling over the last few years. So all these factors are actually adding into a weaker macro structure. And when we have a weaker macro structure, we can't really take market returns for granted. We actually have to look at merit-based ideas and themes that can deliver the kind of returns and compounding expectations that investors have, which leads us into investments, right? So in this kind of environment, you want to be more defensive, but you want to be consistent, because you need to look at ideas that can weather difficult times. You can't have ideas that only work well when the conditions are good, right? So this is something that we need to think about. And of course, in today's context, we also need to pay attention to what's happening on the weather front. How the monsoon develops can really influence the sentiment around markets as well as investment opportunities. So I have touched upon macros. We are, of course, in a phase where investors should prepare for higher inflation as well as lower growth. Whether that happens or not is a secondary question, but mental preparation for this weaker macro structure is important. And what are the habits that we have cultivated in the last 5 years? I think one habit has been to just automate investments and assume that consistency is going to take care of outcomes completely, right? And while consistency is important, if you just have an SIP running, that is not actually going to solve everything. This is a market where one-time investments will make a huge difference. This is a market where the kind of SIP that you're running actually matters. It's not a it's not a level playing field where every idea is going to work. So investors who are more tuned to this nuance are going to come out a little bit stronger in the outcome. The expectations have been pretty high, meaning I think we've been swinging from, oh, once the war is over, everything will be fine, to nothing is going to be okay for a while. And these two poles that exist in terms of market sentiment are actually just extremes, right? The truth is somewhere between the two, meaning everything is not going to be okay once the war settles down. We have inflation that has come in, that can be a little bit stickier. Money is flowing out of Indian markets, so we need to be a little bit more cautious about where we're putting money in. Valuations in certain pockets are expensive. So when we are cognizant of all of this, there is a need, there's a very important need to sort of manage risk levels at where we are today. And so I think a more cautious approach to investing is warranted. At the same time, you need to maintain some level of optimism, right? You can't be completely pessimistic and completely cautious. At the same time, you can't be gung ho about where we are today. So one important thing that we've kind of realized in this journey to 10 crores, right? So anybody who's crossed the 1 crore mark and then they're scaling to 10 crores, there is a point where they plateau in this journey. And there is a fear that, okay, you know what, like I'm doing whatever I did before and I'm still not getting to the milestone that I want to get to. Things are slowing down. So why is it that portfolios don't scale beyond a particular point in this journey? And I think it boils down to a single word in terms of discipline. And we have talked about discipline before. And when I think about this, you're looking at, say, rebalancing, right? So there are four elements that I would put into the discipline bucket. So you can have rebalancing, you can have investing, you have context, and you have goals. Now, when we look at rebalancing, we see a lot of investors who've made money in certain themes are unwilling to rebalance out of their winners. But winners and losers are cyclical, and I'll show you how that works out. And there is a need to sort of move from your winning positions into newer ideas that can work for you in the next cycle, right? So if you're somebody who's made a lot of money in either precious metals, small caps, and you want to kind of look at the next set of ideas, one thing that holds many investors back is that, okay, you know, if I book these profits, I have to pay tax, I have to restructure this portfolio. I'm anyway a long-term investor, so how does it matter whether I get out of this or not? I have an asset allocation model, let it just work out for me. But that's really not the way that you need to look at things. You need to look at it from a relative expectation and return potential standpoint, right? Can the same thing be repeated over the next 5 years? What are the conditions that you would need for that repeat to occur? And do those conditions exist today or not? And when you recognize that maybe what contributed to past success is not there anymore, then there is a need to rebalance. So this is a question that you have to go through with your portfolios and kind of understand whether this is something that you need to do. The second thing, of course, is investing continuously. And many people feel that, okay, like, you know, in Milestones to Wealth, the goal is that we kind of let you saving 1 crore, right? So by the time you save 1 crore, you've actually got more, close to 2 crores or higher in your portfolio corpus. Now, if you've managed to do the heavy lifting of saving 1 crore, now a lot of people think that, okay, like I've already saved 1 crore, why should I do any more? Let that itself compound on its own. Now, that doesn't really work out as well, because your timeline to achieve 10 crores in today's value actually takes much longer. The last is when you have to bring the third point is you have to bring your portfolios into the current context. And this basically goes against the I'm a long-term investor argument, right? It doesn't matter what you own because anyway, my horizon is like 10 years, 15 years. But it does matter what you own, especially if you are ambitious and you want to make that extra return. If you're okay with a mediocre market return, then I think it doesn't matter. But if you're the kind of person who actually wants to advance your timeline, right, from say 20 years to 10 years, then what you own and how you own it and how you contribute to your portfolio really is going to make a huge difference in this journey. And lastly, we see a lot of lack of discipline coming into goal-less portfolios, right? So there's somebody who saved 1 crore, the portfolio value is much higher, and then they think that they can draw down from this portfolio for everything that they need, right? But when you don't have a wealth corpus, which is a separate target, and then you try to bring all your goals into that, then what tends to happen is you tend to draw down from your portfolio at the wrong times or for the wrong reasons. So planning is very important, making sure that you have separate goals and separate investment strategies to sort of achieve these goals. That's what is going to give you a head start. So when I look at the cycle, right? And why it matters that you rebalance and why what you own makes a huge difference. You need to understand that even the best or the safest investments go through cycles. So let's take the example of gold. If we see from 2010 to 2012 was a pretty fantastic period for gold as an investment. You basically all kept seeing positive high returns and much higher than the average return. But then when we look at the next almost 4 5 years, gold returns have been nothing. So that period between 2013 and 2018, most investors would have lost money in gold if they bought it in 2012, 2013. Right? Then you had another positive cycle, say from 2019 till 2025, with the bulk of the returns coming from 2022 onwards. And why was the 2022 to 2025 period so powerful for an asset like gold? It's basically because of one key global change, which was that in 2022, Russia invaded Ukraine. The US froze Russian assets as a countermeasure to this invasion. And because global Russian assets were kind of frozen, central banks started getting a little jittery and they said that, you know what, holding dollars does not seem to be such a great idea. Maybe we should just go and own gold because gold is the next globally accepted currency, right? So there was a huge demand from central banks, which kind of changed the entire demand supply dynamics for gold itself. And today you're kind of seeing early signs of central banks monetizing the gold reserves that they built during these periods. So when you look at this, right, this is broadly what we need to understand, that context has changed. The There is a cycle that is changing. You can still see positive returns, like nobody's calling anything a top or a bottom, but we need to understand that the context is no longer what it was, say, 3 4 years ago. So what is the power of stepping up? So let me give you a very simple illustration. Let's assume that two people start investing today. Both of them have 1 crore at their disposal. Uh, the first person decides to do no additional investments, right? So there's absolutely nothing that they do additional in their portfolio. The second person invests almost 3 crores more. And this 3 crore additional investment happens over a period of time. And it's done as let's say from today, there's like a 1 lakh SIP that runs every month. And that SIP is increased by 10% every year, right? So now in that case, the contribution that goes in is close to 3 crores. So somebody who's invested 4 crores versus somebody who's invested 1 crore, you get to 10 crores in 20 years, and then you get to 10 crores in 13 years. So you shave off 7 years of time. And you can also discount this number back to see, okay, like what is the equivalent value that both these portfolios have, right? And the person who's consistently saving actually has a higher present value than the person who's just done 1 crore uh, 20 for 20 years. So the idea is that many of us want to advance these milestones and you want to increase your spending power. And with something like $1 million milestone, it is a moving goalpost, right? Rupee valuation is constantly changing. So only if you also contribute to the heavy lifting, are you going to see those timelines shrink? Are you going to see those values shoot up? So lastly, when it comes to goal-based investing, I think there are like I wanted to talk about few of the disruptors that you really see. When you're in that 0 to 1 crore or 0 to even 2 3 crore journey, the kind of disruptors that you tend to see are household emergencies. So not having like an emergency reserve to pay for appliance replacement, repairs, maintenance, these kind of things are the reasons why you draw down on your portfolio. Uh, you also tend to see this mentality that, oh, if it's an insurance premium, that's an investment too. So if I'm paying for life insurance or health insurance, I'm not really putting that into my budget. I'm actually putting that into my savings bucket, which is not the right way to approach it. You do need to keep money aside for insurance. You can't be dipping into your savings or stopping your SIPs to fund these things on a monthly basis. Uh, you also have things like school fees, which tend to be done like at the end of the year, or people rely on their bonus to kind of get them ahead in terms of making that school fee payment. This needs to be flipped over, and you need to actually have a structure in terms of mapping out these goals, keeping a solid emergency reserve. We recommend starting with somewhere between 3 to 6 months. Then, as your lifestyle expands, you need to kind of make sure you're closer to that 6 month mark. If you're doing transitions in life, you want to move closer to the 12 months. So let's say you're planning to buy a house. Let's say you have like a life milestone, like getting married or having a child. You do need to ramp up and scale up your emergency reserve. When you're beyond this, right, I feel like as the portfolio size grows, then it's more spontaneous and indulgence oriented expenses. So things like taking a last minute vacation, things like, especially like, let's say if your portfolio is about 5 crores, you want to spend 5 lakhs on a holiday, you don't think it's a lot of money that's coming out of your portfolio. So that mentality actually has to change. The idea of having dedicated goals, dedicated savings going towards specific goals, and tracking and spending according to that without disturbing your long-term portfolio is very, very important. So now we'll conclude with the roadmap to $1 million. You need to start with a plan. You need to understand that unlike a typical goal, like let's say a 1 crore portfolio or a 5 crore portfolio, this is a moving goalpost. And this is going to change as the rupee valuation also changes. You need to have a timeline, right? While the goalpost is moving, what is completely in your control is to set a timeline and maintain that discipline. And finally, I think the question that comes to everybody's mind is, okay, like, obviously, where I invest, what I like, whether you should do it through stocks, whether you should do it through a PMS, whether you should do it through mutual funds. These are questions that many people have. And I think again, it boils down to discipline being a lot more important than the products, right? So what is within your comfort zone or slightly outside your comfort zone, which you feel you can sustain and scale, is far more important than whether it's a mutual fund or a PMS. And this is where I think like a lot of investors need to figure out what works for them, and then either be able to implement it on their own or work with a professional so that they can get the right guidance and choices as well as ideas through the market cycle. So I'll quickly talk about two of our initiatives where we are working very closely with investors. One is, of course, Milestones to Wealth, which I've mentioned a couple of times in this webinar already, where we work with investors from wherever they are to their first crore in savings. And once, if you're beyond the 1 crore mark, then we will work with you on the $1 million milestone program, right? So that is something that we can take you through. We work with more than 7,500 clients today in this program, and we manage close to 1,200 crores in this. We also have our own in-house PMS strategies where we're able to cater to investors with different risk and return expectations. So we have slightly more conservative products like a high quality large cap fund. We have and our multi-asset strategies, of course, which tend to cater to investors with a low to moderate or a moderate to balanced risk profile. And then for investors who are seeking slightly higher return expectations from equity, we do have a flexi cap as well as a small cap strategy that we run. So depending on your expectations in terms of how the compounding journey should be, what kind of returns you want to set for your portfolio, etc., you can opt for any of these products. And many of our investors who are in the $1 million milestone program do a combination of PMS products or a combination of mutual funds and PMS as well. So that leaves us to the end of the presentation. And we would love to work with you on your journey to $1 million milestone. But if you'd like to know more about MDM, or if you want to have a conversation with our team, please do scan the QR code and you can drop us a message on WhatsApp, and we will be able to get in touch with you and schedule a one-on-one dedicated call. So specifically, if you'd like to talk about your journey, your portfolio, you want to know how to take things forward, a one-on-one conversation may give you a lot more insight as to how we can help you. And we look forward to working with you on your $1 million journey. Thank you.